You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Okay, how we're doing? I'll try to be as enthusiastic as Rich was. That was a lot for 8:30 on a Friday. Thanks everybody for coming here this morning. It looks like my under bet on the attendance is blowing out right now. But thank you for coming. This is great. I'm Pat Hickey. I'm a managing director at OCC in charge of participant services and solutions, which deals with new products at exchanges, new exchanges themselves, and clearing members that OCC clears on behalf of, and all the enhancements and commercial things that they want OCC to get involved with. So I'm going to hand it over to our panel here to introduce themselves. So Matt.
Sure. I'm Matt Weinstein. I'm in institutional derivative sales at Citadel Securities. I've been in that role about 3 years. Before that, I spent about 16 years at BlackRock on the buy side, in roles managing options-based portfolios, and then more recently running the options trading desk. So I have perspective from kind of both sides of the institutional aisle, and hopefully I can share some perspectives today.
Sean Truett with Box Options, one of the 16 exchanges everyone always talks about. Been there for about 6 years, just prior to us opening the trading floor. So kind of the focus here will be the institutional flow that we see through our trading floor.
I'm Megan Morgan. I'm head of market structure at Belvedere Trading. I've been at Belvedere for about 14 months now, still talking in toddler years. Prior to that, I was at Eurex for 10 years running business development for equity and index derivatives.
All right, great. Thanks for that. So I wanted to take this panel and kind of start off with talking about some of the assumptions that we even have about what institutional trading is with respect to options and what it means, and actually just to kind of set the stage and the background for what these folks want to do in our markets. So first off, I think we kind of have a good understanding of what retail is, and what they want to accomplish, what they want to do, what it kind of looks like. But what does that mean that institutional is? Is it just everything else that's not retail, or is there something else, in between? Like what is institutional flow?
I can start.
Yeah. Okay. Thanks, Matt.
So I think when people try to figure out, a lot of people try to read the tape and say, this looks like retail flow, this looks like institutional. I think it can be hard, and I'll give examples on both sides. So if I'm an asset manager and I have an order to buy 2,000 ABC calls, and I put it out there electronically, I might get 1,500 fills, right? To a lot of people that might look like a retail order. It's 1, 2, 3 lots in each clip. Or a bunch of retail orders, but it's actually an institutional order. On the flip side of that, maybe there's somebody sitting in their house that worked at GE for 25 years, was an executive, built up a huge stock position, uses options every once in a while to hedge that position, right? So through their wealth manager or whoever, they might buy 10,000 puts, or they might overwrite that GE position in a 10,000 block order. Now, is that an institutional order? This guy doesn't trade any other options, and it's just one person sitting in his house. It's kind of a gray line. So it's hard to tell, right? At Citadel Securities, we have we're fortunate to have some data, right? We have retail flow coming in, one pipe, and then we have my group, which trades institutional. So we can kind of tell some of the time, but I think if you're just trying to read the tape, it can be very difficult to decipher retail versus institutional.
Yeah, I agree with everything you said there. I mean, from an exchange standpoint, it doesn't really matter so much. We do treat, like, the larger orders do get treated a little differently as the way that they're executed on the floor versus the retail that comes through, or things that look like retail that might be institutional. But as we've seen technology evolve over the last 10, 15 years, it used to be easier to decipher the difference between the two. Now with smart routers and everything and dividing the orders up, it's a lot more complicated and confusing to do. So,
yeah, I mean, I'm just going to be an echo chamber here, but that is like, we don't have customers. We are a market maker, so we just interact with flow all day without knowing who. Well, obviously we have information of who the counterparty is through the data, but I would say the way we look at it is the size of the trade rather than who's behind the trade. So, we look at it as a retail size trade or an institutional size trade.
So Sean, you brought up a good point about the way order routers work now and carving up orders and things like that. How does it look to you from the exchange standpoint? Like, can you tell the difference between a retail order and a quote unquote institutional order that's been carved up? Do you treat those any differently? Or
not treated any differently at all. They all come through the same mechanisms, execute the exact same way.
Okay. So it sounds like we're kind of right back where we started with not really being able to define a clear line between retail and institutional, which is, I think everybody already kind of suspected. So thanks for that. So from there, now that we know what the activity kind of looks like in the markets, who's behind this activity and what are they doing? Matt, you gave a couple examples already, but who are these entities? How do they access the markets? How do they get to you, to the exchange?
Right. So when you think about institutional players, it's a number of different institutions, right? So you have your asset managers, you have your hedge funds, you have your ETF providers, you have your pension funds, your insurance companies, and others. So again, there's multiple ways that these institutions can execute orders. Our preferred method is they come to us, obviously, and ask for a price on a block. But they certainly can trade electronic. They can also go to an agency broker, an IDB, and try to shop flow. But I think the most interesting thing about the institutional player, about who they are, is how it's changed over time. And obviously, as we've seen growth in the options market in general, the reason for the growth is actually a lot of things. It's market structure, but it's also just, if you think back to the early 2000s or even before that, the institutions that were trading options were very few. And they were using options to hedge or maybe for a little bit of leverage. Now fast forward to now, there's a lot more institutions trading options. There's retail trading options. And they're not only using it to hedge, they're not only using it for leverage, they're using it for alpha in their portfolios, right? Options are now a part of almost every portfolio, and hence the growth that we've seen in the market.
Yeah, I agree with that. And I think that what we've seen as they've become more advanced in what they're doing, right? So you've got different hedge funds funding or hedging either just a full risk overlay or trying to add alpha. What we're starting to see is more systematic trading that could be perpetual, that we see the same roles coming through and things like that. And I think that shows the real health of kind of the institutional space.
I mean, we don't have institutional clients, so, but I can speak from Eurex. I mean, again, my time at Eurex, just watching the evolution of our customers. You would go in and talk to pension fund managers, and they were just, they were like, listen, I believe in these products. I want to add these products. I understand, how these would add value to my portfolio. But my board is a bunch of retired teachers or retired firemen, and I need to explain to them how a call works and how a put works. And so we are, we want to get there, but it's a long learning curve. And now I think, with the advent of retail getting in, now it's much easier for these portfolio managers to educate their board, because their board probably has a Robinhood account, or so it comes as no surprise now. Again, I haven't touched, I haven't been out in the field talking to institutional customers, but to see that we're, here we are 10 years later, as an industry, we've gotten there.
I think that's a really good point. When you look at we talk about educating retail, everything, you don't think about that from the institutional side. You think maybe they already know how to use these things. And it's not the case. And I think the infrastructure that we've all built and all the tiny pockets that have been filled and the different firms that face that side are very important in educating. And the fact that options, 10 years ago, you could talk to your neighbor and it's a scary thing that no one knows. And now they're becoming more mainstream. That does bleed over. It seems like it should go maybe the other way, or the institutional side should be, a little more sophisticated. But I don't know. I think we definitely build off the retail, and I think it helps the institutional side to everyone more adopting it and much more widespread use.
Okay. Yeah, definitely. One more thing about the who institutions are. Again, if you think back, 20 years or so, the average portfolio manager was either an equity manager or a fixed income manager. The multi-strategy stuff didn't really exist to the extent that it does now. Most of the options came from equity managers, but if you went to a guy that has been managing portfolios for 25 years and you said, I think you should start trading options, he's going to look at you like you're crazy, right? Just like, no, I'm a stock picker. This is what I do. You're like, why would I want to use options? Like, I love the stocks that I own, and the ones I don't like, I don't own. That's kind of gone, right? So the new age portfolio manager knows equities, knows fixed income, knows how to trade FX, knows how to trade CDX and all sorts of different asset classes. They also understand the value of trading options, right? So again, the growth, the evolution of the options market is owed a lot to how the portfolio manager has evolved and to how to be a player in this market. You can't just understand one segment of it. You have to understand the whole thing.
That's a good lead-in. So, but I've had a view that the evolution of retail with individual investors, what's evolved is actually the tools that they have to access the market, the experience with it, the lowered costs, easier access for them, but who they are themselves has not really changed much. They're individual investors. Maybe the demographics have changed much. They're getting younger. They're more diverse, which is great. But how has it evolved from the institutional side? Are there really new players and types of entities, not just fixed income or multi-strategy managers, but are there all brand new entities that haven't been in options before that you're seeing come into the market?
Yeah, for me, the ETF provider stands out. You think about all the buffer funds and those products that continue to grow, that use a lot of options, and not just listed. I know we'll get into Flex later, but they're using different products within the option space. There's a lot of growth and a lot of new products. Just now, again, there's an understanding of how to use options and how they can add value and be a portfolio of something that people are going to want to invest in.
Yeah, I agree with that, and really not much to add besides as they come on, then there's just a snowball effect to more people adopting that are kind of in the same space.
So do you think that they're having a positive experience like retail is too? Is that in the institutions that are coming into the market? And
I do. When you look at some of the successful ETF providers out there, and the options that they're using in their funds, I mean, you see the build in these funds, and a lot of it is coming from what you might call a retail community, right? And if I'm an ETF provider, where am I getting a lot of that money? It's from the RIAs of the world, which who serve the retail community. But yeah, there's a general just better understanding of options and a lack of fear of options, which was definitely there a decade ago. But yeah, you see a lot of these products, able to launch and launch with $500 million, $1 billion, seemingly pretty easily.
So let's talk a little bit about how institutions use options. Like, when you're interacting with institutions, Sean, like what what do you find that they have an appetite for? What are they most interested in? What seems to have what seems to attract them?
Well, what we see most on the trading floor is the facility is there for these very complex options. So whether it's just a general complex trade, a multi-leg trade that has multiple legs with very odd ratios and things like that are tough to put up on electronically. So it's hard to say exactly what they're hedging and doing that, but we see very complex multi-leg spreads that go across like wide strips. We see the same things kind of being rolled out like to further expirations, to my point before, of just a continuous perpetual trade of them rolling them. So I think that it's hard to say exactly what they're doing, but I feel like it's becoming more and more complex as we go along, which I think shows a lot of health.
Yeah. Megan, when you interact with institutions from Belvedere, like what do you see there? What do you see them gravitate towards using Belvedere as a counterparty?
Yeah, I mean, this is it. Institutions is again, as we've talked, it's like such a broad. It's like someone saying, "I have an Asia strategy," right? No, you have a China strategy, a Japan strategy, a Taiwan. Like when institutions use a variety of mechanisms because they want to have their special sauce. So as a market maker, you have to be able to be in all the places, right, that they want to be. So, we are an electronic market maker, yes. We have 8 guys in the SPX pit. We do flex, we're prepared to take the flex business on. And you kind of want to make sure that you're present at all places. I mean, and if they want to do a 1 lot, they want to do a 2,000, lot complex order in the pit. We want to be in all the places. And I think what is, having come from European market structure into U.S. market structure, what I think is such a win for the U.S. is that that we have all of this, and we have regulation that mandates that every order, no matter what mechanism it's used, has to be shown to the entire market. And what that allows us as a market maker to do, so as opposed to in Europe, if you're doing a block trade, you can do it in the block trade market and the electronic market. All these markets are very separated. Nothing touches each other. So they become different liquidity pools. And unless you are, getting the call, if you're just sitting in the electronic market, a huge block can go up without your knowledge, and then you're just a sitting duck. But in the U.S., us as a market maker on the floor, in the call-around market, electronically, et cetera, because we're seeing the trades that are going down, even if we're not a part of it, we're at least seeing it. And that allows us to continue to pump liquidity in all the different venues and mechanisms with the confidence. So deep, tight markets all the time because we have the confidence that we are seeing everything. And that really allows us to make, the best markets we can everywhere for institutional customers, no matter what size or what venue they want to come into.
It's an interesting angle that when you bring up about Europe, we had this panel on international use of options and how that's a growing field yesterday. But Megan, from your perspective, having worked at Eurex and been familiar with institutions there, and now being with Belvedere kind of US-centric, how do you think the experience is for institutions? Europe vis-a-vis U.S. Do they appreciate the U.S. and is that a draw into the U.S. at the expense of Europe, or do both win? Like how do you think they view the U.S.?
It has been a talk at this conference. Many of the providers, execution providers, are now spending more and more time in Europe. And not because they want to connect in Europe, because the customers want to come, they want to come to the US. And I think it is, that was the hardest job I had at Eurex, was trying to convince new entrants to come into the market, because big, tight liquid markets are good for trading, but they're also good for marketing, right? So it was without a very liquid order book, it is very hard to get, again, going back to the, it's not just the PM you've got to convince. He's got to convince his board. He's got to convince his risk manager. And the perception becomes reality because they look at the order book, and it's like, yeah, but you could, the call around market is big. You could call, everybody's connected, and they're like, yes, but this is where everybody else is going to look, right? Is this order book, and so that is when you have, bifurcated markets that aren't touching each other, you can't see the whole. It's not transparent. So this is where the U.S. I think this is why, as asset managers are building they're growing their assets under management and they have to deploy it somewhere. There's only so much they can deploy in the European market, and now it's just not growing enough to in line with the amount of cash they have to deploy. So they're just looking in the U.S. markets.
Yeah, I will say, having traded, both Europe and U.S. options, trading in Europe is very difficult. The fragmented market structure really makes it hard. And just the idea of risk in Europe is very, very different. We provide liquidity to, a lot of counterparties who are based in Europe. And when they trade the U.S. market, they're always surprised at the amount of risk that we're able to provide. I can tell you from experience, if you go out to a broker and try to get risk on some kind of an option on any of the European markets, it's really, really difficult. So the advantages that we have, being the U.S. listed market, and the market structure that we have, the ease of being able to provide risk and execute on the exchanges, it's really a difference maker. And just right now, it doesn't exist in European markets.
Okay. Let's back it up a little bit. Sean, you talked about institutions prefer what they largely kind of involve themselves with is more complex strategies. They're more sophisticated. They understand the product better. They can dial in risk as they needed. They know they know the complexities of the market and how it works. But where does Flex fit in as being kind of the pinnacle of complexity or a custom kind of contract?
Yeah, it's something.
Institutions use
It's
Flex?
something that we've seen. From our perspective, we've seen a lot of interest and a lot of ask, because currently at Box, for our trading floor, we don't offer it, so we are rolling it out fourth quarter of this year. And so we hear from a lot of our participants on upstream who are requesting Flex. We've seen from Henry's slides in the past, there's been an increase in volumes in the last. The increases primarily before the last retail jumping before that were mostly SPX and kind of those product based, and we've seen it come into single stock equities, the ETFs a lot more. So, I think it's a compliment. I don't know that it's necessarily pulling from OTC. I think that both of those have a purpose. There might be some. I'm not that far, on that side to really know exactly why. But I'm definitely seeing the demand. I think there's definitely room for growth. Just this bespoke nature of them, makes them very attractive. A lot is just looking for the European expiration or some other odd things. But there's also some interesting things you can do with them, whether it's delta adjusted and other things that can be done. That's a lot of managers are looking for, that exact hedge on close type of thing. Mm-hmm. So we're excited to get that rolled out and think that there's a demand and definite potential growth there.
Well, yeah, we certainly have a lot of customers who trade Flex. It's a great product. I always refer to the Flex market as kind of a translucent market. Right? If you're looking for it, you can kind of find it, but it's not as transparent as the listed market where something hits the tape and everybody knows it, and it's certainly not as opaque as the OTC market. But I think that also presents an issue for growth. And as Sean said, the S&P product is really most of what Flex is made up of, and those are very specific products that trade that, and a lot of it is very systematic. I think if you want people to trade Flex, obviously there's an education piece, but people are so used to the listed market, just to being able to see the market, to be able to see how much an option is worth, how much is traded, what's the open interest. I think if we want Flex to really expand, then it has to come out of that translucent bucket and come into a transparent bucket, so everybody can actually see what's happening in that market. Then I think it gains market share really, really quickly.
Yeah, I agree, and there are definitely ways that can be done. I don't think that resources and working on that infrastructure at the levels we have now just isn't really attractive enough, probably from an exchange standpoint. But I agree with you. I think that's probably the ultimate goal that we'd like to get to really kind of get that volumes going on that side.
Does Belvedere interact in Flex?
It just won't go away.
No?
Yes, we do.
Okay.
We do. Not our favorite market, but it's there, and that's obviously we want to support the institutional flow and be there. So we are very much engaged in Flex. Yeah.
It would be good to see more transparency in Flex, if for nothing else, that it's going to be hard to figure out how to put translucent into some kind of acronym that everybody can know what this product is that's not Flex. So. You mentioned something too, Megan, about having 8 traders in the SPX pit, and obviously indexes are a very popular product, definitely with institutions, but retail more and more. But what is the uptake of institutions with single names versus indexes? Like, how do they view those two worlds? Is it different entities or different types of participants looking at single names versus indexes? How does that kind of break out?
Yeah, I would say it's market conditions, right? So the more volatile the market is, we're seeing the institutions gravitate towards. Again, I'm not on the client side, so this is just market makers' perception. But when there's volatility in the market, there's more opportunity in the single names, and we see that. And then obviously in quieter times like now, you kind of see that gravitate more towards the indexes, and especially the SPX, even away from the ETFs as well, towards the SPX and NASDAQ.
How do you see it, Sean, from
I would say the same trend that we kind of see in retail with the switch over from single stock names to ETFs. I would guess that that's fairly mirrored on the institutional side, right? We've seen like the concentration single stock with the big boom from post 2020, and then everything kind of switching now back to the ETF side. And I think that just kind of mirrored on the institutional side.
Yeah, I think a lot of it is catalyst driven. Index trades kind of all the time. Index is pretty stable, but if you think around a Fed day or around a CPI print, you're going to see a lot more kind of macro index ETF flow. Singles, if you think about names like Amazon, Apple, Microsoft, those kind of trade like indices. Those are always trading all the time, every day. The volumes are kind of insane. But when you think about other single stock options, it's really around a catalyst, right? It's earnings season. So, our clients are trading a lot of single stock around earnings. They're hedging, their risk, whether they're long or short. They're putting on some kind of a hedge, or they're levering up. I love this name. I think that, earnings report's going to be great. I'm going to buy some calls on top of my long position. But in general, I think options are used around catalysts. The reason that index is steady, I think, is a lot of vol arb funds out there, like guys who are trading vol as a true asset class, are always thinking about dislocations in the market and how they can actually use vol to make money in that way, and they're always thinking index. So not a day goes by where we don't quote a ton of index. There's certainly slower days where there's no vol and no real catalyst in single stock, where our single stock desk can be a little bit quiet. But in general, those Amazons and Apples are kind of always trading, and that'll keep us busy.
Okay. So we made it almost 30 minutes without talking about short-dated options. Here we go. So obviously that's been a big driver of growth in the industry, short-dated options. A lot of that is coming from index or index-like products like the ETFs. Where do institutions fall out on this? I know that there's been a lot of talk about how retail firms handle risks of short-dated options. How does how does that contrast with institutional uptake?
So I can start. One quick stat. Again, we have a lot of retail flow that comes through the Citadel security systems. We also have a lot of institutional flow. In the first quarter of 2023, on our platform, about 25% of retail flow is in 0 DTE options. We like to say 0 DTX, but everyone else is saying 0 DTE, so I'm trying to follow suit. If you look market-wide, including retail, including every other trade in the first quarter of this year, the number was about 20%. So it's prevalent in the institutional space as well. I think it's just used a little bit differently. When you pick apart those retail trades and you start to look at how long a retail 0 DTE option stays on that retail book, it's a pretty short time, right? So retail may buy at 10 o'clock in the morning, by 11 o'clock, and if you look at these kind of hourly time slices across the day, the buy-sell skew is actually pretty tight, right? There's not a lot of kind of buy and hold for the day. It's I buy at 10 o'clock, I'm kind of out by 11 o'clock. Either the market moved the way I wanted it to or I didn't and I'm out, I move on to the next thing. When you look at institutional flow, it's a little bit more buy and hold. It's just so hard to say that when it's going to expire at the end of the day anyway. But it's more of a technical play, right? So you're looking at the chart of SPY and you see, maybe around 11 in the morning, you think it's topped out. I'm going to buy 5,000 or 10,000 puts, and then I'm going to hold them, right? Now, if the market goes down and makes a new low, again, it's a technical play, so I probably sell out of those. If it kind of grinds lower, if it's doing nothing, I'm going to hold it for the rest of the day. So institutions are involved, they're just playing it a little bit differently, and it's so hard to say because it's just a day, but it's a much longer kind of hold in the institutional space than retail.
Megan, how do you see Belvedere interacting with short-dated options, like with institutions? Is it?
Yeah, again, it just goes back to Pat. It's not about, we just don't look at it like, oh, this is a retail order and this is an institutional order. Yeah. It is more, this size. We look at it as the size of the order, right? Yep. So what is the size? And I think in the 0 DTEs, it's kind of just, there's like this, it's just all the same, right? It's kind of, so, and the growth has just been explosive. So, I don't really have an opinion or a comment, just that it's growing, it's becoming, we're getting shorter and shorter every day that passes by. And we're just trying to, I think what we're trying to figure out is where is this going in the long run? How much is this going to be? Is this where everybody's going to gravitate? Next year, are we going to be talking, are the stats going to be 40%, right? And are we really going to have, nooners? Is that really where we're going? So, that's what we're looking at. And then, how do you manage that from a risk perspective? So it's less about, again, and I'm not answering your question and kind of just rambling, but it is less about where, who's on the other side of the trade, and more just where are we going as an industry with this theme?
Sean, do you see a lot of uptake with large block size orders or complex orders that deal with options expiring that day?
Not particularly. I don't think they're worked into the complex. I think they're more maybe worn off. There could be some minor roll type of thing, but I think in the more complex, large institutionals, we don't see it that way. Okay. But I do agree with Matt. It's good to hear Matt's perspective on the institutional side. I'm glad to hear that they're involved in it. Obviously, from exchange standpoint, the volumes that we've seen, it's a great trade for everyone. I think they're probably getting good experience. We know that we're seeing crazy tight markets there, and hopefully it's something that's sustainable. Everyone wants the shorter term. I'm not sure how far we should go or how far it will go, but at the point that we sit right now, I think it's healthy, and everyone loves the volumes.
Okay, great. Well, I want to open it up to the audience now if there's any questions for our folks up here. Did we cover everything? Looks like we did. Not bad. To kind of come out of left field here, I remember during COVID when that's kind of what was one driver or result of the kind of boom in retail trading coming out of it. But institutional did not, maybe even receded, especially at first. There's lots of assumptions made that big exogenous vol event like COVID blew up people's models. Maybe it was being away from out of the office and not having access to the same types of interactions on trading. But it seems to have come back now. It seems like it's a better environment now. Is that true? Are we back in business?
Yeah, I think so. So during COVID, those first couple of weeks was definitely a little tough for the institutional crowd to keep trading. I was on the buy side when it first started, and you didn't know who to call. You didn't know who was up and running. You didn't know if you were going to get a reasonable market, and markets on the screen were very, very wide for good reason. But once everybody got their home setups and once everybody was kind of settled in after a couple of weeks, it was back to business as usual. I think the retail side is interesting too. Obviously, there was that boom in retail trading, and a lot of people thought, once everyone has to go back to work, all these people living in their parents' basement, trading options for free all day, were going to have to stop because they were going to be kicked out of that basement and go back to work. Maybe that happened, maybe it didn't, but we're not seeing retail really fade, right? Obviously, they're not at the same levels that they were during the meme stuff and during the peak, but they're I don't want to say a number because I don't remember it exactly, but they're much, much more active than they were before the pandemic. And the data that we see, we talk about the staying power of retail. We really don't think they're going anywhere. I think by now that they would have gone already. But we're still seeing a massive amount of growth, over time in the retail space.
That's good and something we all want to hear, right? And all that we're hoping for. Yeah, the COVID side, as far as the institutional went, it was a blip and maybe flat for a little while. It was tough with the floors being closed, but everyone adapted very quickly to whether they had to use electronic mechanisms and stuff, and the floors weren't really closed for that long. So it was kind of, now it seems so long ago, right? And it seems like it was crazy at the time, and it had minor short-term impacts, but I don't think overall to the institutional flow of things it really had any long-lasting impact.
Okay. What do you think is the most important thing that the industry can do to help to continue this growth from institutions? Are there blockers? Are there barriers? Is there more that can be done? I know education was mentioned for a lot of these firms. What do you think is the single most important thing the industry can do to help?
I think it's educating and providing a great experience, for the current participants to come in and be happy with their fills and speed of execution, allocation, all the stuff that we all work so hard on every day. That's important, right? At the end of the day, that's what it comes to. That, along with education, tools for them to understand the complexities of the space and use the full option toolbox that they know that we all love and think that everyone in the world should be using, is, just spreading the word. I think it sounds a little simple, but that's kind of everything that goes into it.
I'm a big proponent of education, and that I know, again, I want to provide some different point of view here, but I think, again, just going back to what I had originally said about, I can remember, 10, 12 years ago when I was starting at Eurex, that it was we have to figure out as an industry how to educate the masses on that these are not exotic, scary weapons of mass destruction, but actually can be a good tool to make money. Now, that being said, I think, Bloomberg came out with an article earlier this week that said that there was some study that retail is losing, as an industry, hundreds of thousands of dollars a day. And so we have to make sure, like you said, Sean, that not only are they getting educated, but they're having a good experience. And sustainable and our sustainable experience in the markets.
Yeah, and I think our market structure and liquidity of our markets is just so important and such a differentiator. You think about short-term options, and that's what people want, right? People want to be able to really pinpoint a catalyst, right? Why do I have to pay an extra week or two of time value when you can easily just list daily options, and I can just trade the day I want to protect myself against some kind of an event or a catalyst. So as more and more of that continues, and I'm sure we are going to see shorter dated options in a lot of the single names, that's going to continue to bring players on and get people more and more active. Education is definitely a huge part of it. But again, as the investor becomes more and more savvy, and our markets continue to be the most liquid and the most tradable in the world, I can't see any reason why we wouldn't continue to grow.
That's great. It's very optimistic.
Try to be optimistic.
Okay. All right. Well, thank you, everybody. Appreciate it.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.